Welcome, everybody. It's David Phillips here, the Estate Planning Specialist, and Todd is here with me. Todd, say hi to everybody.
Hello, everyone.
We are going to have a webinar today specifically to talk about the Return of Premium long-term care rate increase that is going to happen here on July the 15th. And we wanted to make sure that all of you knew about this date. We feel responsible to let you know this is happening, and we're going to explain to you why this is it's pretty monumental, and there's some things that you can do to avoid this rate increase, possibly, and so we want to do as much as we can on our part to make sure that you avoid that. But before we do that, get into the nitty-gritty of that part of it, we have some talking points that we're going to cover today, and I want to share those with you. So here we go.
Just sit down.
Let me hit this here. Okay, so talking points. Todd, take the first one.
All right, so yeah, we're just going to go over what we've learned from the COVID-19 and how it's affecting long-term care in America. We're going to also cover how to afford care in the home instead of being in a long-term care facility, which we're trying to avoid, and how the recent announced premium increase will impact one of the top return of premium long-term care plans in the country, and we're going to distinguish what that means. And then we're going to talk about how you can lock in the current low premiums indefinitely on a guaranteed basis so they can't increase the rates like they normally have been on traditional long-term care.
About a week ago, I sent out an email blast to my media people that have recommended us in the past, and one of them is Terry Savage, a well-known financial author. Used to work at CBS, was financial advisor there at CBS in Chicago market. She was also on the board of directors of McDonald's, so she's a very, very esteemed author and actually written many books, The Savage Truth on Money. And anyway, she has a column in the Chicago Tribune, and I gave her a couple of statistics, and she published them. And I think this is probably the most alarming statistic that she published in her article that appeared on June 16th. She says, and I've increased the date here, so her was reported as of June the 3rd. But as of June the 20th, 43% of all COVID-19 deaths in the United States have been residents in a nursing home or an assisted living facility. So what does this, and that's almost half, Todd. So what does this tell us? First of all, it tells us that we never want anyone that we know and love to be forced into a shared room facility. And I think that's where we're seeing a lot of the deaths is in these shared room facilities, especially the Medicaid facilities, where they cram 3 to 4 people in a room. And a worker comes in with carrying the virus, and basically it's all over. And so that's one thing we want to avoid, is to be forced into or put anyone we love into a shared room facility.
So our objective here is to try to give you that choice so that you can stay at home or go into a facility, but you have the option. And we're going to show you how you can leverage your dollars today to have more funds in the future so that you have that option.
But going into a facility sometimes is a good answer, primarily because staying at home puts a lot of stress on the family. When a group of Americans were surveyed, they said 77% of them said they want care at home. 80% of those needing care currently are receiving it at home anyway by unpaid family caregivers. A spouse is 6 times more likely to suffer from anxiety or depression after giving care. And family caregivers spend, this is an alarming statistic, Todd, 56 hours per week in fulfilling this role. That's huge. That's basically dedicating their life to that. 1 in 3 caregivers provide also financial support to those they care for. And 64% say caregiving has a negative impact in their life. Now, I know that they love the folks they take care of. My mom would not trade a moment of time that she took care of my dad with Alzheimer's for 7 years. The time they spent together was very cherished by her, but it was very physically draining, especially toward the end. And so taking care of someone at home has its drawbacks as well. But we know that taking care of those that need care in a facility have major drawbacks, especially health drawbacks. So is this what we want? Is this kind of these statistics what we want for our family? And I think the answer is no. Wouldn't it be ideal if you could either pay a professional, or if you decide a family member, just pay them to take care of you in your home? That would be the ideal situation. The cost of being cared for at home, though, is expensive. Todd, do you want to cover these?
Yeah, sure. So there's 730 hours in a month. If you figure $10 an hour, that's $7,300 a month. If we go to $25 an hour, that's going to be $18,250 a month. And in-home care often costs more than a care facility, even without the cost of housing, food, and utilities. So you could pay somebody $10 an hour, but wouldn't you rather have a family member or a friend? And we're trying to give you the option so you have the cash, the funds to be able to have that choice, who you pay for, how those funds are spent on your terms.
So I think the case here that we're trying to build is that we'd rather have care in home if we can. So how do we afford it? And that really is the main question. Can we afford to do that? Since 72% of us would like to have, are likely to have a long-term care experience, and 77% of us want to have it at that experience at home, you need to plan, prepare, and now we're going to show you how to prepay it. But we're not going to show you how to prepay it with $1. We're going to show you how to prepay it for pennies on the dollar, and that's the key. We're going to use leverage. And that's why we call this concept, this overall concept, a leveraged care solution. So here's our options. First of all, the question is on our care, will Medicaid take care of us? And I think we've hammered this a lot, and most of you that are listening today know that Medicaid is not an option because you have to spend down to be Medicaid, and you don't want to be in a Medicaid facility, right? 4-door room, no, you don't want that. You could also purchase a standalone long-term care policy, but we've kind of hammered that one too through the years in that right now it's extremely not popular and very expensive, and rates are increasing all the time. I'm talking to people every day now that have had rate increases and they want to know what to do, and standalone really isn't working. You could be rich enough to fund everything for yourself and do what's called self-funding. And I know that is a viable option, but after we end up today, I hope that we have dispelled that option, because even our wealthiest clients get it. They understand the idea of leverage. Not one person that I know bought their first home with cash. Everybody used the bank's money to buy that house with. That's leverage. We're going to take $1 and create $3, $4, $5, and we're going to show you how to do that. And then we're going to show you how to reposition some of these assets into what we call the leveraged care solution. So the new answer to the long-term care dilemma is this leveraged care solution. And it was created for us with the Pension Protection Act, and specifically Section 844. And in that 844 section, what it did is it allowed for tax-free benefits to be paid to us as individuals if we trigger the long-term care event. We'll talk about that in a second. But the idea really is your reposition of pennies today to create guaranteed dollars in the future. You take cash from your left pocket to your right, and it's still an asset on your balance sheet. You can grow this dollar that you put into here to $3 immediately, and it can even grow up to $10. If you dodge the long-term care bullet, which is everyone's goal, and we know that 80% of women won't dodge it, and 60% of men won't dodge it that are over 65, so 72 of the populace won't dodge it. But if you were lucky, if you're one of the 28% that dodged it, the account balance or a life insurance benefit is passed to your beneficiaries. So it's not a use it or lose it proposition like traditional long-term care insurance. Okay, so let's talk about the trigger mechanisms for the leveraged care solution. Todd, do you want to talk about that?
Sure. So you will need a doctor's note, or there's a form that the doctor will sign, and this is the most common way of activating a long-term care policy, the benefits, is by getting this doctor's form that says you can't do 2 of the 6 activities of daily living. If you've been researching the long-term care market, you're probably familiar with these, but it's eating, bathing, dressing, toileting, transferring, and maintaining continence. So if you can't do 2 of those 6 activities, that would trigger the benefits of the policy.
There's also another trigger that's independent of those, of the 2 of the 6, and that's cognitive impairment. So if you wake up in the morning, you can't remember anybody's name, you've got Alzheimer's.
That's actually a very common, one of the most common triggers is the cognitive aspect that we're finding with our clients.
Correct. And that's part of this leverage care solution. That's a trigger mechanism. It's the same as traditional long-term care. It's the same qualifying for Medicaid. You have to be able to do those, not be able to do those things, or those are the same trigger mechanisms. Okay. So let's talk about the leverage care solution options. So the first option that came around was called the long-term care annuity. And we're not going to spend any time on this because that's not our focus today. We're not having a rate increase there. But a long-term care annuity is just that. It's an annuity that is worth, you put in $1 and it's worth $3 for care. Plain and simple. No, not a whole lot of frills.
Those are pretty simple concepts.
The life leverage, the life legacy long-term care combo is a little bit different in that it has a life insurance policy as its core benefit. So let's say your life insurance benefit is $500,000. Your long-term care benefit is 2% of that $500,000 per month for 50 months, or $10,000 a month. That's paid out to you, tax-free. So in essence, because of Section 844 of the Internal Revenue Code, you become the beneficiary of your own life insurance policy, and it's paid out to you tax-free. It's a very common plan. It's been around for 15 years now. A lot of great companies offer this.
Those are typically fully underwritten plans.
Right. Whereas the annuity is just an interview. That's
right.
Correct. Yeah, that's a good point, Todd. And so a lot of people like that option. The option that we're going to want to focus on today, and the one that seems to be the most popular right now, is the Return of Premium long-term care. And we're going to focus our attention on this because we have a pending rate increase here on July 15th for one of the top plans in the country. So Return of Premium long-term care basically is where you take a dime to generate $1 in long-term care benefits. And that really is an actual leveraged concept there. The benefit is paid out to you between 48 and 84 months. Most everybody's choosing the 72-month option. Seems to be the best place to be in this plan. And the benefit is paid out on a cash indemnity basis, and you have a immediate life insurance benefit. It has a life insurance as its chassis. If you decide after 5 years, if you did the single deposit, you want your money back on the 6th year, you can get all of your money back. So that's why, again, we call it Return of Premium. So right now, here are my bullets that I have. You either receive the benefit your family, if you don't use it, your family gets the life insurance benefit. If you decide to bail on the plan, you get your money back. But the third way to get it, the benefit, is you get a benefit of cash that is paid out to you as a long-term care benefit. You have inflation options with this one, which you don't have in the other two versions, and you also, no medical exam is required. I think the key to the return of premium long-term care, though, is the way the benefit is paid out. It is a pure cash indemnity benefit, which means, this kind of goes back to our very first couple of slides that we talked about, which means you can have anybody come into your home and take care of you. With most of the plans that are reimbursement, it has to be a professional. And that's probably where, you may end up having a professional take care of you. That's fine. But you're not going to start there. Most likely you're going to start just like 82% of the population does. You're going to start with a family member taking care of you. And here you can pay the family member to take care of you. And you can stay in your home. You have that option. So a cash indemnity payout is critical. And if you can get that, that is obviously the best option for you. And you can also do multiple deposits in this plan. It doesn't just require a single deposit. You can actually put in 5, 7, 10, 15-year deposits depending on your age, to get the plan. And it's interesting because if you decide to do the 5-year plan, you actually get the full benefit the very first year, the first day that the plan goes in, and you only put in 1/5 of the premium that you were going to put in. So pretty important. Multiple deposit really comes into play for those that have IRAs or 401ks, and that's where their money is, and they want to leverage it and get the care benefit. So let me kind of give you my example here on the way this all works. The way I kind of envision this is I have $100,000, and let's just say the $100,000 is in a CD right now, and I take that CD and I cash it out because CDs aren't paying anything anyway, and I gather the family together in a family meeting, and we're all sitting around the table, Christmas time, and I say to the kids, I'm going to take $100,000 and I'm going to put it in my Folger coffee can here, and I'm going to bury it behind the oak tree in the backyard. And if I ever need care, if I ever can't do 2 of the 6 activities of daily living, or I can't remember your names, I get dementia or Alzheimer's, go back and find in the backyard, uncover this money in my Folgers can, and take that money for my care. And my daughter says to me, Kelsey, she says to me, Dad, you don't know what you're doing here. I just listened to Dave Phillips' webinar and Todd Phillips, and I just found out that you could take that $100,000 and you could expand it at least a minimum of 3 times for care initially. But if you add the inflation rider, it's going to grow to 5 to 6 to 7 to 10 times what you put in if you need care. And Dad, if you don't need care, we get the money. We're going to get the money anyway. If you die, I know where it is in the backyard, but now you have the ability to expand it by 5 to 10 times. And so that's the idea of the leverage. It's basically like taking money, repositioning it from your left pocket to your right pocket. It's still an asset on your balance sheet. So when you do your asset allocations and you're listing your assets, this is an asset on your balance. It's not gone. It's not money spent. It's money transferred. It's money repositioned. And you have to think of it like that because it allows then to transfer if you need it for your care. If you never need it for your care, somebody gets that money. to me, it's a win-win for everybody, Todd. Okay. So, in your pre-webinar invitation, we had a couple of questions. I call them long-term care math questions, and I want to ask you that question here today. Or Todd, why don't you ask the question for us?
All right, sure. So yeah, we wanted to give you three options here, and these are some of the top plans of this type in America.
So Steve is a male 65, and he says, Dave, I heard about the coffee can thing. I want to transfer from my left pocket to my right pocket $100,000, and I have it in my Sleepy CD, and now I want to get this Return of Premium long-term care. So, which plan is better? Company A,
give you an instant pool of $273,586. That's paid out over 72 months, $3,799 per month as a reimbursement of expenses. So this is a reimbursement plan.
And this actually is available right now today. You could go out and grab this one today. If you're healthy, you could grab it today.
It's not bad. It's good.
It's a good leverage. It's a 3-to-1 return right there. You put in $1, you get a pool of. And this is one without inflation, by the way. But it's a 3-to-1 return, not bad. But Company B, I think, is actually even better, Todd, because it's offering a long-term care pool of $398. That's paid over 75 months, $550-$300 a month. But it's also a reimbursement. So I have to actually have a professional caregiver give me care, correct?
Right.
Okay. Company C, though, is an instant pool of $419, so that's a little bit better than Company B. It's paid out 72 months, so it's a little bit more of a benefit payout. It's $5,800 a month. It's a 4-to-1 return. So for every $1 I put in my coffee can, take out of my coffee can, put it, I'm going to get 4 for care.
Right.
But it's a cash indemnity payment. So, my question up there on the top, which plan is better? Let's stew on that for a second. I'll let all of you stew on that for a second. Which plan is better? Can you see that there? Now, I presented this very same concept to a gentleman the other day, and he chose Company A. Okay, I've lost a lot of hair over that one, a lot of sleep. I don't get it, but he did. Okay, and he told me that the reason why he did was because his stockbroker can only sell Company A, and he likes his stockbroker. That is a lot of like, a lot of love. Okay, Now let's look at, we know Company A and B is not, so Company C obviously is the answer. I think we drew that conclusion together. So let's look at a little closer now at this Return of Premium long-term care plan that we're going to be talking about today that's going to have the increase. And it's a male 60, he's going to put in $100,000, and this is the one without inflation, so the pool is immediately 5 times for a 60-year-old, so $481, $6,688 for 72 months paid out. And that's without inflation. If we add inflation to it and we do the 5% compound, we start out with a lower pool, but the pool increases by 5% of that 323, a math calculation. There's no outside forces here. It's just straight up compounding math. By the time he's 85, that pool has increased to $1,100,000.
And we're seeing that, especially the inflation option, if that's something that's of interest to you, that's probably going to be the most affected aspect of these rate increases.
Yes, that is correct. And you can see that the monthly payout goes from $6,600 without inflation to $13,000 at age 85, when at the prime time for claiming this plan. So the idea behind this is that the benefit increases through the years, and it's available to you. And here's another important part of this too. This money comes to you tax-free. So if you are pulling money out of a taxable account like a CD to take care of your care, or a stock account or whatever, you got to pay taxes on it. This year you don't. This is tax-free money that comes out to you for your care. So it really is even more money than you're seeing here because it's tax-free. Of course, if you never ever trigger, if this male 60 never triggers the long-term care benefit, his family either gets his money back, a little bit of death benefit, or if he decides, you know, hey, I'm going to go over to Leisure World and I'm just going to give them all my money and I don't need this anymore, and you want your money back, after 6 years you can get his money back. So it's a true return of premium option. Okay. Now, let's look at the multiple deposit option. So we have a female 60 doing a 3% inflation with a 72-month benefit, and she puts in the $100,000, but she does it, but she's going to do it for 7 deposits of $17,436. So this is her initial pool of almost 4 to 1 that she puts in. Long-term care benefit, but it's going to increase by 3% inflation compounding, and it'll be at 6.5 times in 20 years when she's 80 years old. Okay, so you can do a multiple deposit here. She's doing 7 deposits. So you can do a single deposit, 5 deposits, 7 deposits, 10 deposits, or 15 deposits, depending on your age. Okay, and that's her monthly long-term care benefit. It doubles in 20 years. So very critical to see. And you want you to understand that as an option. Okay, now let's go back to our question, our pre-webinar question. So if Steve knew, this is question 2, if Steve knew that Company C was going to increase their rates 10 to 15% on July 15th, would he? Now, before I answer that question, let's look and see what actually this rate increase is going to do. So right now, Steve, remember he was 65, can take that $100,000 and get an instant long-term care pool of $419,000. Again, this is the one without inflation, but you'll understand this when you see this. That's the pool, so 4 times what he can get for $100,000. After July 15th, Steve will need to deposit $115,000 to create the same $419,000. Can I let that sink in here for a second? $419,000, same benefit, $115,000 versus $100,000. Or if you do the multiple deposits, it's the same idea. It's going to have it's going to increase, and each age cell is going to be different. But we know the minimum increase is 10%, but up to 15%, depending on the cell, the age of the individual. Okay. So let's go back to our question. If Steve knew that Company C was going to increase their rates 10 to 15% on July 15th, would he let his sleepy money keep sleeping? Go to Vegas and put it all on red? I did that one time with a friend. He was on black and I was on red, and it landed on green. Okay. C, call us, and here's our phone number, 892-1102, 892-1102, or visit ropltc.com. We've had this web address up there the whole time. Most of you are on that, you know that, so that you can submit an application request form, okay? So you can apply for Company C and beat the rate increase. So let's talk about how we can do that. Todd, why don't you walk them through the steps?
All right, so yeah, you can go to the website and submit your application request.
And by the way, we have created a special website just for this plan, ropltc.com website. Obviously, we're going to have to change the numbers and everything like that after the 15th, but for right now, everything is current. Or you could even go to our other website, which is epmez.com, and I think most of you have been there, the estate planning website. But it's ropltc.com specifically for this. And then what do you do there, Todd?
Yeah, just click Get a Quote, and then you'll fill in your information, and that will then send to us that you're interested in a quote. we have several representatives ready to help reply. If you don't hear back from us right away, don't be shy and go ahead and call us at that 888-892-1102 number. Sometimes it is kind of busy right now because of this deadline, but yeah, definitely.
Well, and it's busy. It's busy because Terry Savage told all of her readers. Mark Skousen just told all of his. Carlson just told his, and David Ivory kind of told his through Retirement Millionaire. So, kind of an important, that we are busy, but that doesn't mean we can't help you.
Right. And we want to help you as best we can.
Then what you'll do from there is you will submit the analysis request. We'll send you the quote. You decide which plan you want. But the key right now is number 3. You need to complete, sign, and send in your application to our office by the end of business day, July 15th. I cannot emphasize that any more than I am right now. That is the deadline. It has to be in our office by July 15th, your application. Well, but David, I'm not really sure exactly that I want to make this transfer. I want to investigate the company, and I want to make sure that their 96 Comdex rating is really 96 and it's not 92 or whatever. I want to do some investigation. That's fine. You can do that after you have the application in and submitted. The application means absolutely nothing as far as a financial commitment is concerned, because you have to get approved, and that's taking a little bit of exercise right now, because the company is being they're being a little stingy on this one right now, because they know that they have absolutely the best game in town, as you know that, and just by the examples that we showed. It's by far the best one out there, and it's got to have the rate increase, and probably with the rate increase it'll still be the best, but it'll be 15% more. It'll require 15% more to get the same benefits that you are today. So again, the steps: visit us, request an analysis, get the analysis. Then from there, on that analysis, there is an application request form. And submit that application request form to us, and then from that application request form, we will then submit that. We'll send the application back to you for signature. Once you have sent that back to us, we will forward it to the insurance company, and you're in. So the steps: get a quote, choose the company. Choose the plan.
You can change that plan later.
Yeah. Fill out the application request form. We submit the application back to you for signature. You sign it, and you're in. Okay, we submit it to the carrier.
You have a deadline, yeah.
And we have a deadline that's a little bit later than your deadline, but your deadline is July 15th. And this is kind of an important little segue to this here. For this plan, just this plan, applicants need to be healthy. And I think with all plans they need to be healthy. But I think better than healthy now. You can't just be, in the past we were able to get type 2 diabetics through, and we're not now. So you have to be healthy and under age 71. So if you aren't under 70, if you're 71, 72, you can still get a plan.
Yeah, we have plans all the way up to 85, but this particular one, you need to be under 71.
Yeah, that's having
and healthy.
This is the one that's having the rate increase. Why we wanted to talk about it so bad today. So we wanted to make sure. Okay, we have a couple of questions.
And you can go and hit the little dialog box up top. You should be able to see that. I don't know where it is on your screen, but you can type in a question there, and we can see that, and then we'll answer it for you.
Todd, do you want to take the first question?
Let's see here. Is the long-term care constrained to the U.S. only like Medicare?
That's a good question.
That's a great question. It's not U.S. only. But there is you get a lesser amount. So if your maximum is say $5,000, they're going to give you half. So it would be $2,500 if you're outside of the U.S. So if you went over to Thailand and your benefit here in the U.S. was $5,000, you'd be getting $2,500 over in Thailand.
Now, if you ask me that question and we find out that you absolutely are going to go foreign for care, we have another company, similar plan. They've already had their rate increase. They had their rate increase back in January, and they are 100% foreign.
Right.
So you would probably go with them if that's the company if that's the kind of benefit that you're thinking about. So great question, and we have a solution. We know all of the solutions out there. We know everything that's out there. There's nothing we don't know at this particular point in time about this leverage care solution. We've studied them all, so we know, and we know where the best deals are, and obviously that is one of the options. So, okay, next question, Todd.
Can this policy be for both spouses? So, great question. This is an individual plan, so you would both be getting your own plans. You'd both be submitting the premium for yourself. It's not a joint option. We do have a lot of husband and wife that get it, but they are getting individual plans. We do have some joint options available. There's going to be some give and takes by doing those joint plans that we could discuss if you want to do that. This particular plan, which we feel is giving you the most leverage for your dollars in on the indemnity payout, and it is an individual plan.
Correct. Good answer. Okay. I'll answer the next one. What is required to get approved? Do I need to do an exam? Okay, well, hopefully I answered that one earlier, but I'm going to answer it again. So let's go back to the slide that's on here right now. You request a quote. We tell you what your options are. You decide which option you want, how much you want to transfer, how much do you want to reposition from your left pocket to your right pocket. Remember, it's not an expense. I had somebody ask me the other day, how much does it cost? It doesn't cost anything by the same aspect of go buying a dress or a bed or car insurance or homeowners. This is not a cost. This is a transfer. And you're transferring the money from your left pocket to your right pocket. Sure, it's costing you interest because you're not going to earn any interest on that money. And in fact, if you decide to take the money out 6 years later, you're going to get your money back without interest. But you've also been insured for the long-term care benefits. So you decide which plan you want. Then you fill out the application request form, telling us which one you want, and then we pre-populate the application and send it back to you for signature. You sign it electronically usually, and it's signed and sent back to us. We then forward it to the home office before their deadline, and you're in. You don't have to spend any money. There's no transferring of any assets yet. Then they interview you. And that's kind of, I guess, your question there. Do I need an exam? It's not a medical exam to plan. It's an interview plan. But you do need to be healthy. So you can't sneak anything by them because they're going to do a prescription drug medication check, and they're also going to do what's called a Medical Information Bureau check, and they're going to find out if you have any issues, and if there's anything there, and they find it, that's significant. It has to be significant. You could get, you might not get approved, and
so a lot of times on healthy people, we're getting approved 2 to 4 days. I mean, it's pretty quick if there's really no issues when you do the phone interview and nothing really comes up on your MIB check and your prescription check. But sometimes, you got 65, 70-year-olds probably have something going on in your background. Sometimes they will want to get an attending physician statement, some kind of medical records pull, and that can take a little bit longer to get approval. No exam, but they're going to need those records, and that can take a little bit.
Right. Okay. Well, so I think we've kind of hammered this. Let me just emphasize one thing. We have quite a few visitors with us today, and I just want to emphasize this one thing. Right now, we are very busy because we are answering a lot of calls from people that are calling in from the different financial gurus that have been recommending us. we're also going to be going to the Freedom Fest here in Vegas in July, and so our time is limited. And I know you can go anywhere else and get this probably, but I want to emphasize, if this is something that you want to do, if you think about it, this is, yes, I want to make sure that I can have my care in my home and not have to rely on my family to take care of me. I can pay my family to take care of me, or I can have a professional come in and take care of me. I can stay at home and I take care of myself. I want to do this transfer, reposition X amount for my care. Folks, do it, and do it now. You will regret this if you don't do it now and you don't get the application in now. I cannot emphasize that more. I've been in financial business and insurance, estate planning for 48 years. I have seen these rate increases come for different things: term insurance, permanent insurance, family bank stuff, annuities. We've seen annuity rates go down. These deadlines are real. These companies aren't messing around. They are real, and you need to get your application in. I think procrastination is over. You can't use that one anymore. You can't say, well, I got something else going on. I'm too busy. I'm too busy planting my garden. No. Now's the time. It'll take you just a few minutes to get the application filled out and send it back to us, and then we'll get it to the home office. So anyway, that's my plea to you today, that you get your application in so you can avoid the rate increase. Todd, any last words?
No, we just want to get the word out and make sure you guys all have this opportunity. And
tell your friends.
Yeah, tell your friends. If you know somebody that's healthy, under 70 that needs long-term care, this is a great opportunity to get in now. I don't see overall market interest rates going up in the future. And so probably in this low rate environment, we're going to see pricing maybe even go down even more in the future because of where the interest rates are and the ability of these insurance companies can make money on their portfolios. And so this is a great opportunity now to hold this rate while you can.
And remember, all of the numbers that you see, not only in the examples that we showed you today, but when you get your individual illustration, all those are fully guaranteed. They're not based on market or timing or the phases of the moon or anything like that. These are fully 100% locked in and guaranteed. What you see is what you get, and so this is an opportunity for you to take advantage of. I don't know. We knew that they were going to increase the rates. Right. We just didn't know when. And when they told us a week ago, we said we have the responsibility, obligation to tell those that have talked to us, and so that's what we're doing today. Thank you so much for your time. And if you have any individual questions, please call 888-892-1102. Call our toll-free number. And most of you have that number because you've contacted us before. Appreciate you, and have a great day. Take care.